Hi, and welcome to this Evershed Sutherland PROPcast. I'm Heather Tomlinson, a professional support lawyer to the real estate practice group here at Evershed Sutherland. Our subject today is all things retail, and I'm joined by Charlottesmart, who's a partner, and by Owen Dutton, who's a legal director. And they're both in our real estate practice group. Charlotte and Owen are both experts in dealing with all things retail, so I'll hand over to you to introduce yourselves and the type of work that you do, and we'll start with you first, Charlotte, please.
Thanks, Heather. Morning. As Heather said, I'm a partner in the real estate team and I'm based in the Leeds office. I specialise in retail leasing and I work across two of our product groups, the corporate real estate group, which is tenant side, and the investment management services group, so landlord side. But I predominantly act for a small number of the UK's biggest retailers across their brands and portfolios and have done for a number of years.
Thanks, Charlotte. I'm Owen Dutton, a legal director in the real estate team in the Birmingham office. Over the last 15 years, I've also specialised in retail leasing. I focus on iconic large retail destinations in city centre locations. These often form part of the heartbeat and social fabric of the cities that they serve. As a point of difference to Charlotte, I act landlord side and represent some of the UK's largest retail landlords.
Thanks very much, both. So I think it's going to be really interesting to hear from you both on the landlord and tenant perspective. And our session today is about discussing the dynamics of retail letting and asset management, looking at it from both sides of the fence. So we're going to be thinking about expansion and consolidation, changing rent structures, the need for flexibility, and the move from online to physical retail, amongst other things. It's quite a good time, I think, to have this PROPcast because the British Retail Consortium has recently published some data on footfall, which showed that for the 5 weeks to the 1st of February, the UK footfall had increased 6.6% year on year, and that showed increases across retail parks, shopping centres, and the high street. So against the backdrop of that sort of latest news, I think it might be helpful for you both to talk about what you're seeing in the market and what general trends are at the moment.
Thanks. So I'm going to kick off then with considering a number of positive trends at prime retail destinations. What I've seen in the last 12 to 18 months is an awful lot of hard work from landlord clients starting to pay off. This has largely been related to finding an answer to the question, what to do with department stores. The demise of traditional brands and department stores has been well documented, but landlords have now had the time to regain control of these spaces, develop repurposing strategies to obtain the necessary planning permissions, identify and secure a new generation of brands, and deploy CapEx where required to reinvigorate their destinations. This effective asset management has brought the considerable amounts of space left by department stores back to life. The strategy has been to carve up the space and bring in a range of new uses that are complementary to each other and give customers a journey through their visit. Starting with mini anchors. We're now seeing a cluster of new mini anchor stores, for example, flagship M&S or Inditex brands such as Zara, Bershka and Pull&Bear, each taking perhaps a floor of a department store footprint. They are being aligned with the best of internet-only brands, making the leap into bricks and mortar. And they in turn are being positioned near the very best competitive socializing venues, which, for example, blend a revitalized take on bowling with virtual reality games, together with good food and a great bar. Brands such as Lane 7 have really nailed this. It's also been superb to see new technology emerge with new entrants to the market, such as football simulator Toca Social. As these high-quality clusters grow, it's had the knock-on effect of encouraging other existing occupiers to invest in better refurbishments so as to not be left behind. Therefore, as a result of careful destination curation, strong landlord and tenant online presence, and clear marketing and community engagement strategies, I'm seeing large sections of retail destinations being transformed and relaunched. It's been incredibly well received by the public, and importantly, by a younger demographic. The most eye-catching launch in 2024 came from the makeup brand Sephora at Bullring, where customers queued through the night to be first through the door. Sephora created a carnival atmosphere, and this resulted in what was probably the largest opening event since Bullring opened 25 years ago. It's important to note, though, that these launches don't stand in isolation. And one of the reasons for the hype was that this section of Boring had seen close to 20 new brand launches or refurbishment within the preceding 18 months, and other key brands also launched in the same week. So the sense is really of a new destination being created. It's also important to note that this approach has significantly now driven down voids, increased competitive tension in the market, and led to more ingenuity in the use of space. These success stories have built market confidence and a framework for revitalising prime destinations nationwide, which is just brilliant. We've seen positive movements in the market elsewhere, with prime retail now attracting further investment from institutions and quoted property companies. A really good example of that is Landsec's recent acquisition of a stake in Liverpool One. So lots of great things to see.
Yeah, I mean, I agree with Owen. It's definitely more of a positive outlook than the media would lead us to believe. There's some obvious challenges that won't have escaped anyone's notice that face retailers this year, and I'll touch on those a bit later on. But my own view is that the landscape has shifted more positively. We've come out of that pandemic era now, which was just a whirlwind of deals that largely focused on damage limitation and de-risking real estate. As Owen said, the market stabilised. Both landlords and tenants have invested heavily in their retail portfolios, and particularly those prime retail sites. Owen mentioned department store voids, and I've acted on a number of flagship stores which have filled those large voids left by the likes of BHS and Debenhams. And the investment in these stores is significant. You know, they're really innovative, interactive spaces and driving footfall, which ultimately just benefits everyone. Since the start of the year as well, we've seen quite a few retailers reporting that they're looking to expand. Examples being Gales, Hotel Chocolat, Space NK have all made recent announcements. And Mango said that they're going to target an additional 20 stores and announced a second Oxford Street store. Holland and Barrett have said they want to open 50, and Primark have also mentioned expansion plans in the press recently. And that's all really positive for retail. I think retail parks will continue to be really attractive to retailers. That big box layout means that retailers can often negotiate much better flexibility and the fit out costs are lower. The prime sites are very much about brand awareness with a strong focus on the store reflecting the brand, and the retailer will invest heavily in those. Whereas retail parks conversely have that more kind of stack it high approach and drive high sales. They're also incredibly attractive destinations for consumers, given the ease of parking and access to do kind of click and collect, which again is critical for retailers to have that online support there. British Land have announced that they're going to continue to commit to those types of schemes in the press. I think that outlets are and continue to be attractive spaces for retailers and will do again this year. They're a great opportunity to sell surplus at a discount, and the occupancy rates have gone up. Outlets rely heavily on turnover rent, so for retailers there's a good deal of risk sharing with the landlords here. And outlets tend to be cheaper for retailers to fit out again because the stores are on a bit of a smaller scale and usually much less complicated to fit out, and quite often they can take over from what the previous tenant left. And again, with right investment from landlords, the outlet spaces are really attractive for consumers with easy parking and good facilities. So I've mentioned prime sites and out of town, which I think will all continue to trade well. However, there's always two sides to the story. And I think the traditional high street will continue to be challenged and we'll still see some void space there. From a tenant point of view, these are actually the hardest leases to negotiate, as private investors who quite often own that space are fiercely protective of it and the terms that they negotiate on. And they do tend to have less experience. They also have to compete with the huge investments made in shopping centres and prime retailing space that's designed to draw in crowds. And they can't compete, so they don't attract those new entrants to the market that Owen was talking about. It's not helped by business rates, which means that it's harder for smaller retailers to make the cost of renting on those high streets work. I'd love to see a real focus on this side of the market, as I think it offers a unique opportunity for the high street to evolve and attract those independent traders. But I think it is going to require some significant investment from the government or local governments. But perhaps we are seeing some positivity here. There's a couple of building societies who've announced plans to expand, and I'll be interested to see what happens with the WH Smith portfolio. The popularity of pop-ups and charity shops is also growing as people shop more consciously.
Thanks both. That's really a useful overview of what you're seeing in the market, and it's great to have your perspectives from both sides there. Might be helpful now to, if we move on, to consider how that's being demonstrated. For example, how are retailers and landlords taking an approach to expansion versus consolidation? Charlotte, you touched on business rates there, and the British Retail Consortium has also recently published a survey about the impact of the budget more generally on retail, in terms of the increase in national insurance contributions and so on. So what are your views on what you see retailers doing, and how are landlords reacting in terms of either, expanding into space or planning for consolidation?
Yeah, Heather, you mentioned expansion and consolidation. I think that's the perfect way to describe what the focus will be. The budget will have an impact. The increase in national insurance and the national living wage, as well as new first day rights for workers, will have a significant increase on staffing costs for retailers. And ultimately, that makes the store less profitable. Combine that with the high business rates still, and it just creates a perfect storm. And this will cause retailers to review those portfolios and look to consolidate and close any loss-making stores. Because frankly, the money saved would be better spent improving the stores that are performing well or acquiring new sites in that prime space that we've talked about. Retailers, I think, will look to keep any sites that are on a marginal profit on a flexible basis. So that might look like a shorter lease length or having the flexibility of a rolling break. It might incorporate flexibility in how they use that store or who they share that store with. They're going to want the ability to reconfigure their stores and portfolio and the flexibility to control how that will work. But I do think we'll continue to see the investment that we've seen into the prime retail sites continue as retailers focus on those bigger, better stores, and new entrants want to have a part of that space as well. But the investment doesn't just come from taking on the shiny new stores. I think retailers will look to upsize their existing stores and invest in refits and reconfiguration there. But the investment doesn't just come from CapEx, so from the expenditure on the fit out. They'll invest in the actual lease itself, so agreeing longer terms and securing protected tenancies. Owen, do you agree?
Yeah, I think that's all really interesting and sort of a good reflection on the market. So I guess the question, are landlords consolidating or expanding their space? I think from a landlord point of view, there are strategic decisions to be made in relation to expansion and whether this is 100% retail or with other asset classes coming into play. With vacancy rates much lower now, what is good is that more management time can be devoted to considering their next step. What is clear is how landlords are investing in existing public realm and infrastructure to entice retailers into their schemes. Improved public realm increases customer dwell time and improves experience, gives opportunity for further commercialization of this space. Landlords are also being imaginative as how they use existing space. For example, overcapacity in car parking may now lead to parts being used for paddle courts or go-karting tracks. In relation to improving destination infrastructure, it's clear from ever more impressive tenant fit-outs that power is a key element, with particular demands coming from tenant requirements for lighting and screens. From a legal perspective, time often needs to be built into by the landlord to deliver the necessary power for the tenant's access dates to be successfully met. I think it's also important to touch on sustainability, and landlords are also looking at their longer-term energy strategy and overall sustainability goals. Talking of sustainability, I'm encouraged by the fact that landlords and tenants are becoming more collaborative in meeting sustainability goals. They're increasingly important to their stakeholders. A few years ago, it could be a real struggle, a battle to get sustainability provisions agreed in a lease, but now this is much more market standard. Collaboration includes finding ways to meet EPC targets, having coordinated waste strategies, and sharing data. There's lots that can be said about green leases, and this is something that we can provide separate training on.
Yeah, I agree. It's definitely one for separate training. But just to jump in there on that sustainability point, tenants, they are focused on sustainability goals too, but they'll still be protective of their space and how that operates. So they will be wary of rights that the landlord tries to negotiate into a lease to control those sustainability requirements to meet the landlord's own sustainability agenda. And they'll also be cautious of any costs that are incurred on the tenant in this.
Yeah, so it's clear from what you're saying, there's an awful lot going on and that retail is a really dynamic market for both landlords and tenants. But obviously underpinning those considerations is the physical space that the landlords want to let and the tenants want to occupy. And of course, for us, the legal framework that governs that occupation as well. So how can landlords and retailers ensure that their leases and their other property documents can support and react to the changing nature, both of what retailers want from their stores and what landlords can offer? Obviously, rent structuring is a big one, and we can come on to that separately. But what other issues are you seeing as sort of crucial to landlords and tenants to make those leases work for them in this retail space?
Yeah, so I mean, touching on the consolidation point there, like from a tenant point of view, it's absolutely critical that it can make changes to its portfolio quickly to maximise sales where it can. So by that I mean that the tenant's going to be looking for, the flexibility to make alterations. The ability to change signage, they'll want to be able to share their space with trading concessionaires to use that space more efficiently and reconfigure the stores to enable that to happen. They might look to have the lease as flexible as possible, which allows them to consolidate the portfolio more easily. Break clauses are particularly important to tenants looking for this model rather than a shorter term, as they get the best of both worlds. So the ability to stay if they choose to, or leave if they want to end their lease. But we do spend a lot of time negotiating break clauses. Obviously, from a tenant point of view, we're looking to have as few conditions as possible. And any conditions that are attached to a break clause need to be absolutely crystal clear.
I think it's worth noting here, there's always a balance to be struck from a landlord perspective in relation to lease flexibility and breaks, particularly if a landlord's paid a significant capital contribution. So that's a real commercial call there. If a tenant does want to change the brand operating in the unit during the period of the lease, the landlord will also want to have some control over the tenant mix. So, for example, if a fashion retailer wants to switch to maybe selling soft furnishing or something else that might jar with what's happening in that part of the centre, this will be something that's closely looked at by the landlord.
Yeah, and conversely to the consolidation point, when they're investing in prime retail sites, I think I've seen a move towards more of a traditional leasing model. So to secure and invest in that space, tenants are looking for longer terms with security of tenure and re-gearing their assets in exchange for rent-free or cash incentives from landlords. And of course, longer leases are also attractive to investors.
I think that's really interesting that you mentioned that tenants are looking for 1954 Act protected leases. And it's worth flagging that the Law Commission is currently carrying out a consultation on the future of secure tenure structures, with different models being considered. And that is definitely a topic for another PROPcast, but worth having on your radar.
Yeah, and just thinking about the retailers that I mentioned at the beginning with large expansion plans, they're going to want those leases agreed as seamlessly as possible. So landlords talk about speed to rent a lot from an investment point of view, but it is equally important to a tenant. If they've got an ambitious store rollout plan, the fit out program is going to be really tightly scheduled. If a particular store misses out on its fit out window, it can take some time to slot it back into the schedule and a bit of shuffling around. So getting the lease in place quickly and on time can really help with this. And the more straightforward the lease negotiation, the better for that. My own view is the MCL is actually a really good starting point for this. From an occupied point of view, we know exactly where we are with it and we can mark it up quickly. If landlords can't follow the MCL, then, on those kind of smaller format rollouts, a short form lease is really useful for getting these deals done quickly. And I think we as lawyers can utilise our legal tech tools that are available to us to speed up lettings. And, we continue to invest in those as well.
I agree, speed to rent is also key for landlords, and approaches that reduce negotiation time will always be welcome, whether it be MCL as an approach or shorter form leases. And simplified rent structures also help. So shall we consider those rent structures? Charlotte, I think you've got a few thoughts.
Yeah, absolutely. I mean, the last time I did a podcast like this, I spoke for a full 30 minutes about turnover rents. And that was just coming out of the pandemic. They were so popular during the pandemic when the parties were unsure of what the retail landscape was going to look like. Most of my work during that time was moving leases onto a turnover only deal or a kind of total occupancy cost type deal. And I do still think there's a place, obviously, for these rent models. However, like I said, I think we are seeing more traditional leasing terms. Clearly, turnover rents still have a place, particularly in retail. They're relied on heavily for outlets as well. The added bonus for a landlord, obviously, being as they get that precious sales data, and tenants benefit from the risk sharing element. But rack rents do provide certainty. And I've seen a few open market rent reviews recently, which has made from a change from turnover-based ratchets or index-linked reviews that became popular when inflation was really low, although I suspect the high period of inflation post-trust made those become less popular. Talking of certainty, I think service charge continues to be a bit of a sticky issue. Ultimately, there is a degree of uncertainty of what a full service charge will be, and that means there's uncertainty over store costs. RICS are proposing to issue a new service charge code this year, so just another one to have on your radar. And there's a couple of new heads of service charge that have crept in proposed that extend to environmental and sustainability costs and technology and digital infrastructure costs. And I do wonder if we might see more negotiation around this, or requests for service charge caps or inclusive rents to provide tenants with some cost certainty there.
Yeah, and from a landlord perspective, I think it'd be really interesting to see how the rental market evolves. All the data shows that physical stores provide more benefit to a tenant than just the direct sales, and allows a brand to achieve an omni-channel approach for their customers. Therefore, the question is, how is this best recognized in the rent structure? For the moment, I think turnover rent probably is the best way of valuing and sharing the upside, but let's see where this goes.
And talking about let's see where this goes and sort of the evolution of those rent structures, I think let's sort of move towards rounding up our session by thinking about the future of retail. Based on your wealth of experience, both of you, where do you think retail is headed? Are we going to continue to see a move from online to physical space? Where do you think we're going?
Yeah, so I think there's going to be continue to be an increase in competition in the market from hospitality and leisure. We've seen that as an increasing trend over the last couple of years. I mean, in the last 2 weeks, I've seen several heads of terms pass over my desk for leases to chicken shop chains. And yeah, I mean, I don't think retailers will necessarily be moving from online to physical retail space, but certainly the use of those prime sites will really drive the brand and their online presence. Interestingly, you know, retailers occupy space that isn't necessarily profitable at all just to keep up a brand presence in that area, central London being a really good example of that. Prime retail space is a destination and a day out for people, so it's important to have a good mix. Tenants are going to expect their landlords to continue to invest in the experience outside of the store to attract footfall. And you know, differentiating retail space will become more and more important. Whilst this PROPcast has had a positive theme overall, I think it'd be remiss of me not to highlight again that the single biggest threat to retailers this year are the tax implications that came out of the budget. You know, the biggest retailers in the UK have been really vocal about this, estimating that the cost of, you know, national insurance, national living wage, and a new packaging levy that was introduced is going to increase their tax burden, or the tax burden to the retail industry, by 7 billion. So whilst I think we can be optimistic, it should be treated cautiously. And I think we'd all love to see the government make some changes to business rates this year to try and balance those tax hikes out.
Thanks. So my top 3 things to watch in 2025, focus on the age demographic, investment in technology, and following the fun, I'm going to call it. So focusing on the age demographic, I think landlords will be putting further focus on ways in which to encourage the under 35 age group to engage in physical retail. I'm more optimistic that we'll see more investment by online first brands to encourage into physical retail. It was great to see, for example, Gymshark launching on Regent Street as an example of this. They will promote the next generation of experience-led retail, where customers really get to engage with the brand, what it has to offer, either through exclusive products or quality one-to-one engagement with staff. Landlords can support these retailers by buying into the social values of that community and offering entertainment within the public realm to amplify the brands, particularly as they launch. Technology. Investment will come both in physical and data-led technology. Firstly, Further investment in store technology, which goes beyond screens and self-checkouts to smart checkouts and smart changing rooms that will really enhance the customer experience, getting sizing right faster and reducing queuing times. Secondly, further investment by landlords and tenants in analysing data so they can really understand their customers and how best to serve them. Combining this with social media channels and influencers will allow customers to engage with brands and retail destinations by an omni-channel approach. And finally, following the fun. Fundamentally, retail destinations need to be places where people want to spend their time and go beyond the everyday practical. They must be spaces where the whole of life happens, great places to work, meeting places where communities come together to spend time, eat, play, and enjoy their time together. Places that offer engagement throughout the week and embrace the nighttime economy. The success of retail destinations will come down to landlords and tenants working together to craft dynamic, vibrant, and forward-looking environments tailored to each locality to celebrate their culture and places that people will really enjoy. Huge progress is being made in all of these respects. I think the future looks bright.
Thanks so much. I mean, great to end on a positive note, but of course, Charlotte making an important point there that all that positivity needs to be a little bit optimistically cautious, or cautiously optimistic, perhaps is a good way to sum it up. And I do think following the fun is definitely the message. That's always the message we like to adhere to on the PROPcast series. So we follow the fun of real estate, definitely. So thank you so much to you, Charlotte and Owen, for joining me today. It was an absolutely fascinating insight into this very dynamic market. So thank you as well to everybody listening, and I look forward to seeing you on the next Evershed Sutherland PROPcast. Many thanks.